Welcome to the Fundara. Today, we're going to try and cut through some of the noise around blockchain.
A lot of noise out there.
Definitely. Mission here is really to give you the essential framework,
Mm-hmm.
for understanding and, evaluating this pretty complex world.
It really is.
We'll dig into the core ideas, how these networks actually agree on things, how analysts look at crypto projects, and the big challenges and maybe some exciting future stuff.
Sounds good. Where should we start?
Okay, let's unpack the foundation. What is blockchain at its heart?
Right. So at its core, blockchain is essentially this distributed, shared, digital ledger, but it's immutable.
Immutable meaning?
Right.
It can't be changed once written.
Exactly. And the real key innovation here, I think, is what people call trustlessness. Which doesn't mean, zero trust.
Right, not a lack of trust.
No. It means removing the need for a central trusted party, like a bank or some other intermediary.
Okay, and how does it achieve that?
Well, it relies on three main things. First, decentralization. Control isn't in one place. It's spread out over many participants, makes it really resilient.
Harder to attack or censor.
Precisely.
Right.
Second is immutability. Like you said, once data is recorded in a block, it's incredibly hard to change thanks to cryptographic hashes. Think of them like unique, tamper-proof digital fingerprints for each block linked to the previous one.
Creating that chain.
Exactly. The chain. And third, transparency. At least on public blockchains like Bitcoin, all the transactions are visible to anyone who wants to look.
So it's this combination, decentralization, immutability, transparency, that removes the need for the middleman.
Yeah. It's a pretty radical shift. We move from trusting institutions, based on reputation or regulation, to trusting the system itself. A system guaranteed by math, cryptography, and, game theory. The incentives are set up so people generally benefit from playing fair.
That's a huge mental leap, trusting math instead of people or brands. But okay, if it's decentralized, how do they all agree? How do they agree on the history of transactions and stop someone spending the same coin twice? The whole double spending problem.
Yeah, that's crucial. That's where consensus mechanisms come in, how the network reaches agreement. The two big ones you hear about are proof of work, or POW, and proof of stake, POS.
Okay, let's start with POW. Bitcoin uses that, right?
Right. Bitcoin's the classic example. With proof of work, entities called miners use powerful computers to solve really complex arbitrary math puzzles.
Lots of computing power?
Huge amounts. The first miner to find the solution gets to propose the next block of transactions and earns a reward, usually in new coins, plus transaction fees. Its big strength is its proven security. It's been running for over a decade. Attacking it means overpowering more than half the entire network's computing power.
Which is massively expensive for a big network like Bitcoin.
Prohibitively so. But the downside, as everyone points out, is the energy consumption. It's enormous. Bitcoin uses more electricity than, entire countries sometimes.
The energy use is definitely a major point of criticism. So proof of stake, that's the alternative. How's it different?
Yeah. POS was largely developed to tackle that energy issue. Instead of miners doing computational work, you have validators.
Validators, okay.
And these validators are chosen to create new blocks based on how much of the network's cryptocurrency they've locked up or staked as collateral.
So they have skin in the game?
Exactly. The more you stake, generally, the higher your chance of being picked to validate a block and earn rewards. The huge advantage is energy efficiency. When Ethereum did its big switch, the merge to POS, its energy use dropped by something like, over 99%?
Wow, that's dramatic.
Huge difference. It also typically lowers the barrier to entry. You don't need a warehouse full of specialized mining rigs, just the stake.
But what about security? If it's not raw computing power, what stops cheating?
Good question. POS security is more economics-based. If a validator tries to cheat the system, or validate bad transactions, the network can automatically destroy or slash a portion, or maybe all of their staked crypto.
So a direct financial penalty?
Right. It makes dishonesty very expensive. So you have this contrast. POA is sort of physics-based security expensive computation. POS is economics-based expensive penalties. It's almost a philosophical choice about how you best secure a decentralized network.
That makes sense. Physics versus economics.
Yeah.
Okay, so we have these different foundational technologies, but there are thousands of projects out there.
Yeah.
How does someone, say an analyst or even just an interested person, start to make sense of specific crypto projects? It can't just be about the price charts, surely.
Oh, definitely not. Just looking at prices, well, it's gambling mostly. To really evaluate a project, analysts often use a kind of framework. Let's call it the analyst triad: fundamental analysis, technical analysis, and on-chain analysis.
Okay. The triad. Let's break that down. Fundamental analysis.
So fundamental analysis, or FA, basically asks, what should I buy? It's about the project's core value, its intrinsic worth, if you will.
Like looking at a company's business model.
Kind of, yeah. You look at the white paper. What problem does it solve? Who's the team behind it? What's their track record? What's the potential market size? And critically, in crypto, you look at the tokenomics.
Tokenomics, meaning the economics of the token itself.
Exactly. How many tokens are there? How are they distributed? Is there inflation or deflation built in? And crucially, what's the token used for within its ecosystem? Does it have real utility, like paying fees, governance, accessing services? Or is it just for speculation? That utility part is key.
Okay, so a FA is the what. What about the when? Is that where technical analysis comes in?
Precisely. Technical analysis, or TA, asks, when should I buy or sell? It's much more focused on market psychology and tries to predict future price movements based on historical price data and trading volume.
Charts and patterns and indicators?
Yup, analysts use chart patterns, moving averages, things like the Relative Strength Index, the RSI, which tries to signal if an asset is overbought or oversold. An RSI reading over 70, for example, might suggest it's gone up too fast and could be due for a pullback.
So TA is about market timing and sentiment.
Largely, yes.
Mm-hmm.
And then the third leg is on-chain analysis, or OCA. This is pretty unique to crypto. It asks, is the fundamental story actually happening?
Because the ledger is public.
Exactly. You can directly look at the blockchain data itself. How many people are actually using the network? What's the transaction volume? Are active addresses growing? In DeFi, you look at things like total value locked or TVL. How much money is deposited in the protocol's smart contracts? This gives you a real-time view of network health and adoption that often cuts through the marketing hype.
So you're verifying the fundamentals with real data.
Right. And the real power comes from synthesizing all three. Maybe the fundamentals look great. The on-chain data shows growth, but the technical suggests the price is way overheated. Or maybe the chart looks amazing, but the on-chain data shows usage is collapsing. Understanding how FA, TA, and OCA interact and sometimes conflict gives you a much more robust picture.
That makes a lot of sense.
Ah,
Using all three gives you different angles.
yeah.
Now the potential seems huge, but let's talk challenges. What are the big hurdles this tech faces?
Oh, definitely significant hurdles. One major one is often called the blockchain trilemma.
I've heard that term. What is it?
It's this idea that it's incredibly difficult, maybe impossible, for a blockchain to be highly decentralized, perfectly secure, and super scalable all at the same time. You usually have to trade off one for the others.
Like Bitcoin, prioritizing security and decentralization, but not being very fast or cheap for transactions.
Exactly. Bitcoin makes that trade-off. To handle more transactions faster and cheaper, the industry developed Layer 2 scaling solutions, or L2s.
Okay, what are those?
These are protocols built on top of a main blockchain like Ethereum. Things like rollups, optimistic rollups, ZK rollups, or sidechains. They essentially bundle up lots of transactions off the main chain, process them quickly and cheaply, and then post a summary back to the main Layer 1 chain.
So they inherit the security of the main chain, but add speed and lower costs.
That's the goal. They're crucial for making decentralized applications or dApps usable and affordable for things beyond just high-value transfers. Allows for things like gaming, social media, more complex DeFi.
But scaling isn't the only challenge, right? What about risks? Hacks?
Oh, absolute critical point. Smart contract vulnerabilities are a massive risk. Billions of dollars have been lost from flaws in the code of DeFi protocols. These contracts handle huge sums, and one bug can be catastrophic.
And we hear about bridge hacks too.
Yes. Cross-chain bridges, which are meant to let you move assets between different blockchains, have become huge targets for hackers. They often hold large amounts of locked assets, making them very attractive. And then there's the big one: regulatory uncertainty. Governments everywhere are still figuring out how to deal with crypto. Is it a currency, a commodity, a security? The rules are often unclear or changing, which creates risk for users and builders.
Lots to navigate there. So despite these hurdles, where do you see this all potentially going? What's the bigger picture?
I think the really exciting part is the convergence we're seeing between decentralized finance, DeFi, non-fungible tokens, NFTs, and decentralized autonomous organizations, DAOs.
How do these fit together?
Well, think of DeFi as building the new financial infrastructure: lending, borrowing, trading, insurance, all running on code without traditional intermediaries. Then NFTs provide a way to represent unique ownership of digital or even physical assets on the blockchain. It started with art, but it's moving to things like in-game items, membership passes, maybe even real estate deeds someday.
Verifiable digital property rights?
Precisely. And DAOs are experiments in new forms of organization and governance. Communities using tokens to vote on proposals, manage treasuries, and collectively steer projects, all recorded transparently on-chain.
So DeFi is the plumbing, NFTs are the property, and DAOs are the governance.
That's a great way to put it. Together, they start to form the basis for a new kind of programmable digital economy, one where value, ownership, and decision-making can be embedded directly into the internet's fabric.
It really does feel like this isn't just about, recreating Wall Street on the blockchain. It seems more fundamental, like potentially new ways to organize capital, collaborate globally, maybe even structure communities online. Though, as you said, with some very real, very novel risks we're still getting our heads around.
Absolutely. It's potentially transformative, but the risks and complexities are real. Understanding these different layers, the tech, the economics, the emerging applications like DeFi, NFTs, DAOs, is really key if you want to navigate what feels like the next frontier of digital life.
A fascinating, complex, and rapidly evolving space. Thank you for joining us on this deep dive today.
Subscribe Fundara for more.